Ultimate Traders on Reddit, October 9th, video 3. State of the market. Boy, this is not looking good. We're going to have CPI coming in on Thursday, the 13th of October. I believe we're going to see CPI of close to 8%. That's still too high. I still expect the Fed in November, mid-November, to hike us a 0.75 rate. I expect us in the beginning of December to do a 0.5. My first video today was why they have to keep going, because we don't want to see a stagflation. Stagflation leads to depression. Forget about recession. I said depression. And the Fed is already scared to say recession, so you can't even imagine depression. Depression is when we have unemployment, negative 10%. We have GDP, negative 5%. And we still have inflation like 5 to 10%. Those are critical numbers that you see in a depression. You got to study these things if you want to be a great investor over time. But this video, like I said, we're gonna have bad CPI, but even worse, we're gonna have more earnings coming out. So this week we're gonna have companies like Goldman Sachs, JP Morgan, Bank of America, a lot of the banks. The second week after quarter end starts, and then the third week, a lot of other companies coming out with earnings. Now, Thursday was really, really bad. So AMD revised down sales by 15%. Not only did they revise down sales by 15%, they revised down margins, which means how much money they're going to make, from 55% margins to 50%. So that means not only our sales are going to be down, but the money that they make on the sales are going to be down. So that's like a double whammy. So on Friday, on my Reddit, I was saying, maybe it's time to go in short NVIDIA and AMD, even though the stock isn't as high as it was a couple of months ago. When NVIDIA first did this, NVIDIA revised down two times. They might revise down again and miss. The growth is going to be flat. P ratio, I think his stock is 120 something. If they're going to make around $3 per share, roughly, it's trading at 40 times. For a company that normally trades between 10 and 15 times. They've been trading since forever, over 10 years. I used to trade NVIDIA like over 10 years ago. So it is still high. The P ratio. The multiple is still high. But I didn't want to short it even though they had bad earnings because it has a cult. Tesla has a cult. AMC has a cult. But the AMC apes fear is striking in. The stock is coming down. You might get margin calls. But that's why I didn't want to do NVIDIA. Now, after seeing AMD, I put NVIDIA back on my plays list. My plays watch list has 300 tickers. I put AMD. AMD went down to 58. I think it can go between 40 and 50. I can see NVIDIA going to 75. I'm not saying it's going to go, but I can see it. Even the Tesla cult, I think the Tesla was in the like 221 or 222. I've been saying for the entire year it's worth $100. That hasn't changed. But the state of the market is really bad. With Apple not raising production, CarMax are missing and revising off a cliff. Levi going, revising down. Helen of Troy, that does consumer stuff, revised down. McCormick, which makes condiments. I haven't traded in a long time. The consumer is not spending as much. The consumer is 70% of GDP. These are signs you have to, if you want to do this long term, you have to see the signs and prepare yourself. Pivot, prepare yourself to see what's going on. Now, the problem is this week, we're going to have a whole bunch of earnings, mainly the banks. And then next week, we're going to have like some tech stocks and a lot of others. And earnings, the probability is very high that the earnings are going to come in bad. Not 60, but maybe 55. At 55 to me is when a company misses on top and bottom by like 3 or 5%. When a company misses top or bottom, one or the other, it's an automatic 60. You cannot get a passing grade of 65 if you miss one or the other. There's only two numbers. It's only two numbers. So if you miss one or the other, it's automatic 60. Automatic 60. At 55 is like you miss both. And you miss both by like 3%. That might happen. If that happens, my safe trading range on the NASDAQ still right now is 9,500 to 10,500. S&P is still 3,300 to 3,600. But like I said last week, the problem is my S&P expectations for this year was $220. This week, I can determine whether that's going to go down, whether it's going to be from $220 to $210. Let's see what happens with Goldman. Let's see what happens with Bank of America. Let's see what happens with Chase or Wells Fargo. If all the banks are missing, I'm going to drop down that estimate. So when I drop down the estimate, and right now we're in a bear market, I cannot give the S&P even a 16x. Because right now I have the S&P 16x at $220. So you multiply 220, 16, you come out with close to 3,500. Not exactly, but close. That's why I'm saying the safe trading range is 3,300 to 3,600. But if they're all missing, instead of 16x, maybe I give it a 14x or 15x. Let's say I have the S&P going from $220 to $210 and 15x. 15 times 210, we come up with 3,100. So if earnings are bad, the safe range is going to be like 3,100 to 3,400. Now, that doesn't mean that's going to happen. That means that that's the safe range that the market should trade to without seeing a rug pull. What did we have on Friday? Rug pull. Because a daily crash in an index to me is 3%. So if your index, S&P or the NASDAQ or the Dow drops by 3%, it's a daily crash. That's a rug pull. 2% is a sea of red. 2% is a sea of red. 3% is a rug pull. Why did that happen? Because Monday and Tuesday, the market rallied on bad news. So when the market goes higher than a trading range on bad news, prepare yourself for a rug pull. Prepare yourself for a rug pull. And I'm going to know this week, judging by earnings, how much I'm going to have to take down my earnings on the S&P. Now, this is the big problem. The big problem is, so let's say that earnings comes in this week and it's bad. I'm already figuring it's bad. What if they all revise down for the future and next year? Okay, normally the S&P 500 grows earnings between 5 and 10%. They grow sales between 10 and 20%. What happens? I'm just saying what happens if next year, instead of earning $210, I'm going to put the S&P at earning $200. That means a whole year looks like we're going to be down. I'm not saying that's going to happen, but what happens if that happens? My view here is we're going to be stuck for the whole year, unfortunately. You know, I want to do play of the day, not this week coming, but next week. But it's not going to be safe to do a play of the day. I think, unfortunately, we're going to have to wait till April of next year for things to be better. Because from what's going on right now, just from what's going on right now, the rest of the year is going to be bad earnings. Analysts are going to come revise down, and then companies get sandbag. But interest rates are going to make earnings worse. So the first quarter, even though estimates are coming down, I don't know whether the fourth quarter earnings will be beat. But in April is when the first quarter of 2023 comes out. In April. So at that time, when numbers come down, everything comes down, and companies beat, and we'll be done with raising rates, we could begin to go up. So that's what I'm thinking is going to happen. We're not going to see a good market if we do until April of next year. Now, the thing with that is this is the fastest market ever. No one can time the bottom. No one can time the bottom. I could just read the data and can tell when things are going to get better. So, I'm just saying this might happen. So let's just say we don't hit a low on the NASDAQ or S&P till the end of this year. And the S&P low is 3,000. Once again, I'm not saying definite, but let's just say. And the low in the NASDAQ is 9,000, right? At that point in time, we could have a monster rally in April, but the monster rally is not going to take us to all-time highs. It's going to rally go from 9,000, vicious rally to 12. S&P 500 from 3,000, from 3,000 to 3,600. That's a vicious rally. That's 20%. That's where we're going to make most of our money. So we don't make most of our money by holding on to stocks while they drop. We make the most of our money waiting for good data, so the good data is behind us when we start buying. I'm not going to buy because S&P hit 3,000 or hit 3,200. If you want a dollar cost average, you can. But I'm not going to buy until the data backs me up. So we are ready to rise and all good news coming out. That's when the most money is made. Most of the money is made when we have vicious rally with data that supports us so we can buy. Until then, not me. So that's state of the market.